Hey everybody, it's Larry Berman here. Another wild week in the markets with everything from the debt ceiling actually not going back down to the final hours, which is what our expectation was. Markets breaking out a little bit here. Leadership, although very weak, Friday started to improve in terms of market breadth. Let's have a look at the chart room and let's see what we learned this week. On the economic data front, obviously non-farm payrolls was the big number of the week, but there were all kinds of data points here, and for the most part, were mildly supportive of the bullish case from the perspective of the Fed may pause. We heard from many central bankers this week. We have the moratorium coming up to the June meeting, so we won't hear from any more Fed speak until the meeting. And the last few messages they were very clear on was, let's not call it a pause, let's call it a skip. And so the markets kind of moved the expectations for the next rate hike, and there still is a coin flip here to the July meeting. So make no mistake, the labor market is still strong on the surface, but all kinds of reasons underlying why it's weakening and hence need to see more data. So not too surprising there. Bizarre combination of events here. Average weekly hours down. When you did the household survey, they actually lost 320-ish thousand jobs, and so the unemployment rate ticked up with a lot more people coming back into the workforce. You've never seen this in history where you've seen that kind of an uptick, yet a headline payroll print, which is birth deaths model, like the vast majority of jobs is coming from 20% of the economy. There's just a lot that's very hard to explain. So when in doubt, buy them. And that's kind of what the market reaction was on Friday. So a couple interesting things here. When we look at what happened in the bond market, there was a little bit of a bid earlier in the week. Perhaps call it a flight to safety. No debt ceiling is, theoretically, why are you buying treasuries if they're going to default? But again, as we've said, they were never going to default. So now the eye starts to turn to all this treasury supply coming in. And while definitely the bills market and that repo, multi-trillion sitting in repo is going to fund a lot of that, there's still going to be tremendous coupon issuance, and we see the long end again creeping higher. So where is it going to go? Back to those extremes? Probably pretty darn close. 4.25, 435 area, I still think is a very real chance. We see US 10s tick above 4% again, and that should put pressure on the tech stocks. And so what we should start to see is a bit of a rotation into what has been working this year into what hasn't. And so as we look at the equal weight S&P 500 having a good day on Friday, leading the market, and the S&P 500, where we had positions this week, we did some rotation. We got out of the market cap weighted S&P and we got more into the equal weight S&P. And while we don't love the market overall, there's certainly better value today and for the next 6 months, let's say, versus large cap tech that has been leading here. And almost certainly, if we do see long rates rise, we'll start to underperform again. So that's really, again, the message. That message really hasn't changed. When we think about market breadth, the percentage of stocks above the 200-day moving average, we saw a continue decay in market breadth in May. If you look at the whole idea of sell in May and go away, the top 10 stocks in the US by weight were up over 8% in May. The other 490 odd names in the S&P 500 were down more than 4%. Hence the decay in market breadth and stocks starting to break. Get very late cycle behavior. Don't let the headline averages fool you. about what's going on under the surface. But I got to tell you, this is very painful. This FOMO trade that's going on now, it's painful. And you just can't chase a market like this because it isn't there. You might say, Larry, is breadth going to improve? Is this going to broaden out? And are you completely wrong here? Absolutely a possibility. But again, I don't play possibilities. I play probabilities, and the probability of a hard landing and Fed's expectation for the unemployment rate to go to 4.5% into next year means they've got to shed a couple of million jobs. And when that happens, earnings get hit, we get the revisions down. That is not in the tape today. That is more reflective of what's in the average stock and in the breadth of the market. Bull and bear pick of the week, same ideas, guys. Oil and gas looks very interesting to me here. Again, we continue to see, oil markets push back, another dip this week below 70. Market came in, some rumors OPEC Plus is contemplating another cut. Whether they do or not, I don't know. But some of these E&P companies look really attractive here. Wrote a bunch of puts this week. AR is an interesting name here with puts somewhere between $15 and $20. So, have a look at some of those things in terms of the fits for your portfolio, and be very cautious on market risk overall. Have a great week, everyone.